Now that we've covered the basics of getting your business established, your income and your expenses, I want to talk a little bit about those other types of transactions that happen when you're running a business, primarily moving money in and out of the business. One of the biggest questions I get asked from clients and freelancers is, how do I pay myself? Obviously, you are a sole proprietor. We've established that fact, and that's the assumption that I am creating this course under. So when you are a sole proprietor, that means there's no payroll. You cannot set up a payroll through something like Paychex, and there's no wages. So you're not going to be categorizing an expense as wages. So to pay yourself as a sole proprietor, you literally are going to transfer money from your business account into your personal account. It's as simple as that. This type of transaction is called an owner's draw. So obviously, once you've gone through the steps in this course and set up your business account, all your business income is first going to be flowing into your business account, and then you can take money out of that business account and move it to your personal account. And this is how you pay yourself. I know it seems almost too easy, but really that's how it works as a sole proprietor. Now, in the opposite, if you need to put personal money into the business account, say you have a big expense coming up and you may have transferred too much business money into personal already and you need to put some money back, well then all you have to do is deposit a check or transfer money from your personal account into your business bank account. And this type of transaction is called an owner investment. So a lot of times you'll see in various softwares, they'll either have a combined category of owner investment / draw, or you'll see separate categories that say owner investment and owner draw. Another question that I get asked a ton is, how much should I pay myself? And my short answer is, it really depends, because there's a number of ways to approach this topic, and a lot is going to depend on how much money your business is pulling in and how much of it is profit. So I'm going to show you an example of two different models that you can use to determine how much you want to pay yourself from your business. The first model I want to discuss is a flat rate model. So this basically has two options inside of it. The first is you just pick a dollar amount each month and pay yourself or transfer that money from your business account to your personal account. This is a completely personal decision, and in general how much money you're pulling in and what your expenses are going to be. So anything different, you can choose to pay yourself, or you can choose to say, I know on my personal budgeting side that I need to pull in $500 or $1,000 or $2,000 a month to be able to cover my bills. So that's how much I'm going to pay myself. The other option is kind of the reverse. You know how much you want to maintain in your business account. Say your average monthly expenses for your business are $3,000. So you want to keep at least the next month's worth of expenses in your account. So say you want to keep the balance of your business checking account at $6,000. So you can build your account up to that much. And then as soon as you go beyond that amount at the end of each month or twice a month, you can transfer the difference back into your personal account. So you want to maintain $6,000, but at the end of the month you have $10,000 in the account. Well, then $4,000 goes to your personal and the other $6,000 stays in the business account to cover your expenses. The other model I want to talk about a little bit is called profit first model. This is a system that was created by Mike Michalowicz. He wrote a book called Profit First, and it kind of turns traditional accounting upside down. So in traditional accounting, we use this equation. It's called income minus expenses equals your profit. When you look at a profit and loss statement, which we'll talk about in a little bit, that's how the statement is set up. That's how it's on your tax return. You list your income, you list your expenses, and what's left over is your profit. Mike turned this around and said that you need to be putting your profit first. So you take your income, you subtract out what you want your profit to be, and then you run your business on the rest, and that's your expenses. So this whole system, it's based on percentages rather than dollar amounts, and the premise is paying yourself first and operating your business on the rest. It can work for any income level, and there's a lot more details to the whole system. So I believe I've mentioned this book before, but again, go check it out, buy a copy, at least read the first 5 chapters, and you'll get a better picture of what this looks like. This is just an example of the instant assessment that he has everyone do in the first couple chapters of his book. So this is kind of how he sets up creating your profit categories and how to do your percentages. And this is the target allocation. So the percentages that you can set up for your business based on your real revenue. Again, read the book. I am not officially a profit first professional, which he does have a directory of people who have been specially trained in this. But you don't have to work with a profit first professional to use the principles. I just wanted to let you guys know about it and what that looks like. So one thing we want to remember is that your business will go through different seasons. The longer that you stay in business, the easier it will be to see certain patterns of income and expense. As a brand new business owner, you're kind of guessing, and things aren't going to be as consistent month to month, but you will develop a rhythm. And if you are following these steps and taking action to get your bookkeeping in order, get your taxes in order, it is really going to reduce your stress, and it's going to help you start to see those patterns in your business income and expenses.